Internal controls are meant to prevent and deter fraud. It's important for companies to have internal controls in place in order to do that. Publicly traded companies are required to have internal controls, and those are reviewed by external auditors. A few ways that companies can deter and prevent fraud from occurring are with the following ways that I will describe here. The first one being establishing responsibilities. That's making sure that one person or one or two people are in charge of a specific task. This prevents a non-understanding of who's in charge, and it makes it a little bit easier to see who may be committing fraud or making mistakes. So establishing responsibilities for one person, assigning one person to a task, can help alleviate some of those concerns. Maintaining adequate records means that we have enough information available to trace back any errors or discrepancies. So the more detailed the information, the easier it's going to be to do that. Ensuring assets, making sure that some of our bigger ticket items, the ones that have a higher cost or higher price to us, are insured. Just in case something happens to them, they get damaged or stolen, we're able to replace them and we don't lose as much as we might have otherwise. Separate record keeping and custody of assets. So those that are in charge of the assets, particularly inventory, are not the same people that are keeping track of the records associated with that inventory. So for instance, you wouldn't want your accountant to only write up inventory reports and inventory valuation summaries. You wouldn't want them also keeping track of the inventory, so taking it in and out of the warehouse, being responsible for the physical inventory. That could potentially lead to collusion. Dividing responsibilities for related transactions. So when we're talking about that, rather than separating record keeping, which is usually separating responsibilities among employees, now we're talking about different departments being in charge of different aspects of the transaction. So when you make a sale, one person is making the purchase, one person is handling the inventory, one person is collecting money for the sale, one is recording the actual money collected, sending it in for a check or deposit, and keeping track of the financial statements. All of those would be done in different departments, again, to avoid any type of mishap. Applying technological controls means that it's a little bit more difficult for fraud to occur or misstatements if we have technological controls, so passwords, information stored on computers, things like that. However, it is important to have source documents, the original document, to back up any information that was transferred into the computer system. The last one is performing regular and independent reviews. Regular is often, so probably not once a year, but maybe every couple of months, every 6 months. It depends on the company, but regularly checking records, checking inventory, making sure that everything is accurate, that can deter mistakes from happening and be able to fix them earlier. Independent reviews means someone is looking at our statements and our financial information that does not have a stake in the company or does not have a stake in those actual numbers. So an external auditor could be an independent reviewer, and an internal auditor would not be based, or the pay would not be based on the actual outcome of those financial statements.